Hi, good afternoon. We'll just wait for a minute or two that the participants just join in, and then we'll start the webinar. Thank you. All right, good afternoon, and a very warm welcome to you all. For those joining for the first time, we actually conduct these webinars every quarter, where we invite our fund managers to talk about ASK funds in detail. And today, we have with us Mr. Sumit Jain, who's the Deputy CIO at ASK Investment Managers, and he'll talk in detail about the flagship portfolio, the ASK IEP. So welcome, Sumit, and thank you so much for being on the call today. Sumit, I'll request if you could just take us through the IP portfolio more in detail, share insights on the changes that we've done in the portfolio, how you really see it shaping up, and way forward. What we'll also do is we followed up with question and answers. So Q&A, where I would request the audience members to type in the questions in the chat box, and we will try to get them all answered. With that, Sumit, the floor is all yours.
Thank you, Ajay. My voice is audible?
Yes, loud and clear.
Sure, thank you. Dear friends, welcome to this quarterly webinar on Indian entrepreneur portfolio. What I intend doing this time actually is, while Ajay has set the tone of this, but what I would look to do is first focus on what are the focused opportunities that's there in front of us. And by no means these are shorter term. From investment philosophy perspective, we generally focus on the long-term value creation. Where does the secular opportunity lie? And then there are some global trends which actually makes us kind of think about those opportunities. Having said that, while I may be talking of focused opportunity from top-down perspective, our investment philosophy is really bottom-up. We look for businesses where not only is this opportunity secular, but the focus on quality of management, quality of businesses is solid. Those are non-negotiable. And because we believe that over a long period of time, it's the superiority of business that makes a difference. Markets may be buoyant at some point, markets may be in a bad phase, but it's the quality that actually makes a difference. Post that, we'll talk about how is CY 24 looking like for India so far. And then monsoon update, because monsoon still plays some bit important role, as fairly decent part of our population is still dependent on agriculture. Then briefly outlook, what are the key things that we are focused on, risk, and then we'll come to Indian entrepreneur portfolio. What are the actions, positioning, how has the performance been, right? So starting with the first opportunity, see, clearly world is aging out. When we think about Japan or US, China, for that matter, Europe as well, right? this aging out of world population actually has huge implication on global growth rates. Uh, when population is young, aspirational rather, uh, the need, willingness uh, is significantly different as compared to population which is relatively aged out. Uh, Working age population will actually be higher in young demographic country like India. And we really believe that this demographic dividend that India has should continue at least for next 2 decades. That coupled with huge underpenetration across many businesses that's there, because even basic products, I mean, air conditioner maybe, um, possibly one can say that is still luxury, but it is still basic for many now, as income level increases. So there is a huge underpenetration in many of businesses, which I would say are discretionary variety. And consequently, we believe that there is a huge or significant runway for growth for many of these consumer discretionary businesses, whether they are in consumer durable space, or whether they are in QSR, or whether even tourism, if one think about it, right? Today, the consumption patterns are moving from, one can say, possibly goods consumption to even more of experiential consumption, right? So that would mean leisure tourism kind of doing really well. We are also seeing huge demand in corporate tourism, cultural tourism, medical tourism for that matter as well. Right? So we really believe that this aging out of world population versus India's very different demographic profile offers huge opportunity on the discretionary businesses, on healthcare side. Coming to next opportunity that we think the world present to us is, um, for a length of time, world has not invested into infrastructure. India certainly has not, but so is the world as well. And even this war-torn country also require huge amount of built-up activity at some point in time. And globally supply chains are dislocated. China plus one is also playing a huge role in kind of manufacturing in India for India, manufacturing in India for the world, right? So clearly we believe that manufacturing along with infrastructure investment is coming to a point where we should actually see sustained growth for a length of time. Um, the entire focus on infrastructure investment actually was started by, I would say, largely led by government-led businesses to start with. But we really believe that it is only a matter of time that we start to see private sector capex also kind of starting to turn. And what India presents, why we believe that this is a cycle which will be significantly longer this time, because possibly now when we see a decent growth for a length of time, that will actually be with very contained inflation. We possibly should not see inflation rising in the country dramatically, simply because the focus on supply side has been really large, really high. We are kind of focusing on dedicated freight corridor. We are focusing on uh, reducing logistic cost, having ease of doing business. Production linked incentives are also helping. So to that extent, um, once we have this manufacturing ecosystem in place, we should see a sustained and a superior growth for a length of time. In fact, we really believe that building a manufacturing ecosystem is not easy. Unlike services, which actually can be built relatively quickly, manufacturing ecosystem involves significantly more number of players, and which is why the cycles are also that much longer. In the past, we have seen many a times false start, but at least now it looks like that the start is relatively more solid as compared to what it was anytime in the past. Clearly, digitization is something that is what government has focused on big time. There has been huge focus on public infrastructure, digital public infrastructure, and consequent to that, new business models will also emerge. We'll keep focusing on what are the new emerging business models which will actually be beneficiary of this. There can be some businesses who would actually use digitization to improve their businesses. There can be some businesses which are going to be disruptors. So opportunity actually would lie in both. And then obviously there are some other important themes, whether it is healthcare, uh, because we are seriously short of high quality beds, high quality hospital beds. And this infrastructure needs a huge overhaul. Similarly, agriculture ecosystem, and when agriculture ecosystem does well, we actually would see, not only would farm economy start to do well, anything farm mechanization will also start to be significantly bigger driver, and the entire ecospace around that. One area which has actually come up interestingly is the circular economy. While at the current juncture, the focus is very high on, I would say rather, there are very few businesses in circular economy at the current point in time, but over period, as we start to see policy norms coming up, lot more business models, lot more businesses will also evolve in this area. So these, I would say, are areas which wherein the runway for growth, and that to profitable runway possibly, is very long. How does India score so far from an economic perspective? I would say there are more positive news than negative news. So clearly, IMF has revised India's GDP growth rate upward by 50 basis point. Inflation, which has been a worrying factor, there has been some scaling down of inflation projection. Fiscal deficit is under control, and so is current account deficit. Election outcome. Post our last call, we have seen how election outcome, which has been, I would say, underwhelming though. But what is reassuring is the policy continuing. And when we look at budget as well, the focus on capex has remained intact. The spend on capex activity, which was expected, I mean, we saw 16% growth, expected growth in capex that was announced in the interim budget, and that has been maintained. But other than that, there has been a very high focus on, I would say, job creation, very high focus on skill development, and that is very vital, because for a long period sustainable growth, the societies need to evolve, and to that extent, education, healthcare, job creation, skill development actually will play a very important role to lay the foundation for a superior growth. Similarly, while rainfall started off as bit worrying, June was deficit. But so far we have covered the deficit of June, and the La Nina conditions gives us confidence that, and while we are no expert in monsoon predictions per se, but the IMD projections of calling out La Nina actually gives us confidence that possibly the rural economy, which was impacted for multiple reasons over last few years, should also start to mend. And we just discussed how possibly rural may start to come back, given the fact that the importance of rainfall in rural economy is still pretty interesting. I mean, labor force in agriculture is 45% of the total population, of the total agri force. Rural population is about 65%, while share in GDP is 15%, but there is a decent amount of population which gets impacted because of impact on the rural side. What's our view? What are the key interesting aspect to look for? See, clearly, I mean, from interest rate perspective, given the fact that inflation is no more a concern, we really believe that the interest rate directionally should be down. Don't really want to predict when would they and at what rate would they go down. But from a direction perspective, we really believe that inflationary pressures are limited, and we may not, I mean, world is also short of growth. So to that extent, interest rate may also actually step down. Similarly, global growth, which was so far resilient, but now is being questioned in terms of at what growth rates would at what growth would the world witness growth, right? So election in India clearly has been underwhelming, but then the current budget talks about significant focus on job creation and consumption. Election in US needs to be watched out for, right? That can have implication on possibly trade barriers, non-trade barriers, even global growth rates, right? Direction of growth rates. So that is something that's key monitorable. From the earnings growth perspective, we believe that India is at a point where while Q1 growth has been subdued, Q1 growth was also impacted by very severe heat waves and also election that we had witnessed, right? So ignoring the Q1 performance, we really believe that India incorporate or top businesses possibly should report 13 to 15% earnings growth for next 2 years. What can be the risk? Clearly, India always is vulnerable to geopolitical pressures. I would say so far or at the current point in time, we have better shock absorbing capability or capacity. But having said that, it would still need to be monitored. And election in US obviously needs monitoring. With this, let's see how corporate, we've seen quarterly performance gone by. Corporates have declared their quarterly Q1 results. And much like what we used to see in the past, top line growth for Nifty 50 continues to remain very low. Q1, we've seen Nifty 50 growing 7% in terms of revenue. Profit growth was just about 5% or 4%. But the interesting aspect here is there has been a divergence in corporate performances between commodity businesses and non-commodity businesses. Businesses like ferrous metals, businesses like oil and gas, businesses like cement, for that matter, reported relatively weaker performances. Our portfolio don't have exposure to those businesses. Not only has our profit growth been superior, it has been backed by a very healthy revenue growth. In fact, we believe that we should continue to report pretty healthy revenue growth for the year in entirety this year and next year as well. And now here, till last year, there was a huge divergence in corporate India performance between revenue growth and profit growth. There was a continued improvement in margins. Now, possibly bulk of that margin improvement for India incorporate may already be in numbers. And consequently, we are now seeing the divergence between revenue growth and profit growth kind of reducing. Having said that, we continue to believe our portfolios should continue to report 20% plus profit growth in 25 and 26. Q1 performance has actually been not different. We have grown, our portfolio companies have grown at 18% versus 4% for Nifty 50. X of OMCs, possibly Nifty 50 would have grown in terms of earnings at 9 to 10%. So versus that as well, our performance actually is way superior. How does the sectoral performances look like? Let's start with banks. Clearly, credit low cost has, which actually went even significantly below the normalized number, has started to inch up because those credit cost was something that was not sustainable. But having said that, they will be normalized at some point, but deposit growth continues to remain challenge, and it may remain so. And that will continue to put pressure on margins. What has our stance been on banks? We have had a very limited exposure to banks, and we have reduced our exposure further into banks. Domestic consumption, staple businesses slowdown has stabilized. I really believe that we should start to see some bit of improvement into staple businesses from here on in terms of rate of growth. But will they go back to, or will they deliver a decent double-digit growth? That still remains a doubt. We would still build in for a high single-digit kind of growth for many of the staple businesses. But the pocket of opportunity would be more on the discretionary side. Consumer durable businesses have recorded very solid performance, while summer products like air conditioners and all have reported very solid numbers. But other than air conditioners as well, whether it is refrigerator, whether it is washing machine, we are seeing improving trends. Domestic investment businesses continue to remain pretty interesting numbers. There has been a mixed performance on order inflow side, but that has been more on expected lines because election led to some slowdown in the ordering front. but really believe that investment cycle should now actually be relatively more broad-based. From a pure defense or power or railway-driven businesses, I think we should start to see this percolating into the industrial side as well. Many of the businesses which are of consumable varieties, while at the current juncture may not be reporting very solid numbers, but business should start to improve from here on. IT businesses are no more showing slowing down of growth. Their growth rates again have stabilized at the lower levels. Possibly should again get better, but again, don't expect a very high growth rates from many of the large IT businesses. But the interesting part to look at in those is for 5 quarters in a row, we've seen IT companies shedding their manpower. Their manpower every subsequent quarter was kind of going down. Now we have already started to see mixed trends. So some bit improvement on the overall manpower hiring, and as utilization levels have come to a pretty reasonable level, I believe that overall manpower strength will keep going up, and this has implication on the consumption aspect, right? Pharma businesses on the domestic or on export side have performed reasonably well. Commodities, as we just discussed, profitability has been relatively subdued. GRMs have weakened. Ferrous companies too faced headwinds, pricing headwinds. Non-ferrous have reported relatively better numbers. So overall, what has been the take on in this quarter? XOMC's BSE 500 reported 8 to 10% growth. We continue to report significantly better numbers, and we believe that our divergence in profits versus the benchmark this year should be relatively higher versus what we have seen in the last year. Profit growth is converging with top line growth. Margins improvement are difficult to combine. Consequently, we believe that, and it's not only about margin improvement, performances across caps, whether it is large, mid, or small, the profit divergence is also reducing. So we really believe that the performance divergence across caps, whether it is large, mid, small, should also start to reduce. In fact, in FY24, what we saw was a very, very sharp divergence. Nifty 50 has grown or delivered close to about 30% return, while mid cap and small cap has delivered a significantly higher performance. Given the fact that profit divergence between caps is reducing, we really anticipate that possibly we are at a point where it's not going to be top-down. It's not going to be a area where everything or many businesses do well. It's going to be more bottom-up. Those businesses which actually delivers onto superior performance, actually they should start to kind of differentiate versus others. And so is the case in ownership as well. We saw very significant divergence in PSUs versus non-PSUs. PSUs actually kind of performed way superior versus non-PSUs. We really believe that given where the valuations are, given the kind of earnings growth that can be expected out of those businesses, again, the divergence across ownership pattern should actually start to reduce. Now let's turn to Indian entrepreneur portfolio. Let's start with what are the actions that we have taken in the portfolio, especially let's say talking about over last 3 months. We actually introduced 2 interesting names in the portfolio. First is Carbo Universal and second is FL. And we have exited out of Avenue Supermart and Metropolis. Why have we kind of gone into Carbo Universal? Carbo Universal is actually Murugappa owned company. It's a very solid group from south of India. They have been in this business for many years now. And they are in an industry which is a virtual duopoly in a way. Carborundum and Grindwell Norton both are kind of cater to about 60-65% of the total market. But what market is that? They are actually a player who are into material science, who kind of supplies into any of the manufacturing activity. So a car production would require abrasives, car production would require grinding wheels, car production. So similarly, this company caters to host of industries. So this is a company which is, I would say, a coincident indicator of the economic activity in the country. Wherever there is industrial activity taking place, the products of carborundum universal or grindwell or its competition would be required. So given the fact that we anticipate broad basing of industrial activity as more and more industrial activity production takes place in the country, the business or size opportunity for this company actually will increase. Not only that, this company has actually been investing into material science for a length of time. Consequently, they are in right areas of electric vehicle. They are also into hydrogen ecosystem. While they may be supplying smaller parts, but they are very, very interesting suppliers of these products. Management pedigree is pretty solid. And the kind of ROC that they generate is significantly better than many of the smaller players. So this is one name that we have introduced in the portfolio. Another interesting name, which is Apple India, more into IT space. As we discussed, the many of these software services business possibly should report in a way, business growth of high single digit or low double digit possibly over a long period of time. But this company actually may be termed as IT, but they are more into digital advertisement or mobile phones. And this market actually is growing pretty rapidly. Most of their revenues come from what they call it as EFGH category, which is e-commerce or education technology, entertainment, food technology, fintech, gaming, and healthcare. Right? And we anticipate this company should grow their profits upwards of 25% for next 2-3 years, and a very decent ROI, right? Or ROCE of this company. So this is a company which we have recently added into the portfolio. How does the ASK positioning portfolio look like? As we discussed, we have a relatively lesser exposure in banks as compared to NBFCs. So our exposure towards financials is relatively lower. What are the areas where we are more focused on? We are focused on consumption, not staple, but more of discretionary. We already started to see businesses actually showing relatively better growth there. Telecom is another area for us. We have a reasonable exposure in that area. And it's in a way, a very concentrated market. Use cases of telecom are only increasing. And we really believe that cash flow compounding actually will be way superior than the profit compounding, which itself is going to be pretty decent. So that is a very large exposure for us. Healthcare, and in healthcare, we own the entire ecosystem of international businesses, domestic businesses, APIs, and we have kind of increased that exposure a bit over the last 6 months. Infra engineering obviously remains a high area of focus, and we have about 16.7 or 17% weight in infra engineering. So portfolio is really balanced between consumption, infrastructure, healthcare, and telecom, which kind of then constitutes a pretty decent part of the entire composition. How does the portfolio look like from the cap perspective? 1/3 of the portfolio is large cap. Balance is between mid cap and small cap. We believe that while we don't look at businesses from a cap perspective, this is just a derivative. But suffice it to say, all our large caps are also businesses which we really anticipate to grow at a significantly faster pace than the general market as a whole. We are really bottom-up investor, and cap is a derivative for us. How does the psychographic look like? Solid earnings growth, very superior capital efficiency, both relative in absolute sense and relative to benchmark. We score dramatically better Obviously, this will not come cheap. We are expensive to in terms of valuation versus benchmark from that perspective. But having said that, we really believe that when characteristic of a business improves, valuation don't change linearly, they change rather more than linearly. Because cash flow growth actually turns out to be way superior, and that is what our portfolios represent at the current point in time, and we are fairly confident of how our portfolios should perform. How does the performance look like? Yes, we on an absolute basis, the performance has been reasonable. Relative to benchmark, while Nifty 50 is not the benchmark necessarily, but we have done better than the Nifty 50, but we have been underperforming BSE 500. There has been a very solid contribution of PSUs, as we talked about that PSUs in general have delivered very solid performance. In last fiscal itself, PSU as a basket in BSE 500 was up close to about 89%, let's say 90%, and that its own contribution to the benchmark has been about 8%, right? So as we believe that now the overall performance in markets are going to be relatively more not as diverse as what we saw in the year gone by. We really believe that we are placed very well from the return delivery perspective. Yeah, I'm open to questions.
Thank you so much, Sumit, for that detailed overview. Audience members, I would request if you can just type in your questions in the Q&A chat box. We already have a few questions already in place, Sumit. So let me start off with the first one. I'm just maybe bunching a few questions together right now.
Yeah.
So the first one was that you spoke about Nifty 50 and doing a comparison for the earnings for last quarter, for the current quarter. If you can just also throw a light in terms of how BSE 500 is done, because that's the benchmark, is what people are asking. Into the performance numbers for BSE 500 and relative to our portfolio. I'll cover the next question after that.
So BSE 500 X of OMCs have delivered 8 to 10% revenue profit growth versus our portfolios, which are way higher than that.
18% approximately. So you do see a large gap even on the broader index of BSE 500 versus the IP portfolio.
That is right.
Great. So that's the first question. The second was that, if we are actually seeing numbers getting delivered fairly strongly for the IP portfolio, why do we still see that drag gap? Although you mentioned about divergences with regards to our portfolio allocations not being there in PSUs, at the same time being slightly more large cap biased. But is there anything else you think has been the reason why you see that gap versus the benchmark?
See, some of our business, while what you mentioned are two important aspects. One is the construct of the portfolio itself, which has, we didn't participate into PSUs. And also small cap as a basket has done significantly well. Our exposure to small cap has been virtually very limited, right? So these have been two reasons. Also, some businesses in our portfolio, while have delivered on business performance, we have not seen enough of value creation from those. For example, if you think about Bajaj Finance, while business has been performing reasonably well, we have not seen the kind of value creation that we had envisaged. Has that impacted performance? Certainly, it has. But are we confident of business delivery from the company? Certainly. We should see a very solid delivery from the company continuing. At the current point in time, if you think about valuation of Bajaj Finance versus markets as a whole, Bajaj Finance will report significantly superior revenue growth, or rather profit growth, and ROE. But valuation-wise, it is almost similar to what it is for the benchmark, or what it is for Nifty 50. Nifty 50, yeah, right. So to that extent, some of these businesses wherein business performance have continued, but we have not seen enough value creation, and also some businesses where the impact is temporary, but we remain very confident that the strength of businesses has only improved. For example, a company like EPL Apollo. We had anticipated relatively better numbers from those, but some volatility in commodity prices, some impact on some impact because of subdued demand in the environment has led to a slowdown in their business. But given what our channel checks, given our assessment of quality of management, given our assessment of the depth that they have created, the brand that they have created, we really believe that it's only a matter of time that we start to see very significantly improved rate of growth.
Thanks, Sumit, for that. Again, the next question speaks about, I think you showed a slide talking about the changes that you've done in the last year or so. So the question comes in that on the portfolio turnover side, it's actually gone up. So do you anticipate that as a trend to continue? Or is it just a phenomena that you're just trying to realign the portfolios with the current market scenarios?
Portfolio turnover actually hasn't gone up. If you look at the average turnover over last 7-8 years, that is about 20-25%. And frankly speaking, I don't see a reason for that turnover to go up dramatically.
Understood. The third question was, I think you spoke about healthcare quite a bit and your the confidence in the space that you bought the entire ecosystem as well. The question is that what healthcare stocks have you really added in the portfolio? You did show that, but the question is still coming out.
So, if you look at our exposure on the international pharma side, we have Sun Pharma in our portfolio, which we have added some time back. We have Dr. Reddy's. Dr. Reddy's is a play on US pharma. Sun Pharma is so Dr. Reddy's is a generic play and also doing multiple things. I'm pretty confident that their India business actually will also surprise positively. Plus, they are investing pretty solidly from a long-term perspective. Their R&D spends are given the kind of windfall that they have received because of Revlimid, which is one of the drugs out there in US. They are investing that windfall into R&D or improving their depth, which should lead to a very sustained growth. Then we have Sun Pharma in our portfolio, which is a combination of multiple things. Very solid India franchisee. Very, very interesting specialty pharma play that they are kind of building up. Margins, ROC are just not a concern. Then on the domestic pharmaceutical healthcare side, we have Torrent Pharma, which has been there in the portfolio for a while. I like calling them as execution powerhouse. Not only has their execution been solid, even the acquisitions that they have done in the past have been very measured and have turned out really well for the company. So it's not only about acquisition, but when I think about their execution in India business, they have actually been continuing to increase market share. So over last many years, not many quarters, many years, they have actually been growing at a rate faster than what the Indian pharmaceutical market has been growing at. That along with margins which have actually been industry leading, right? In fact, if US starts to turn for them, their margins actually has scope to improve further. Then we have another exposure, which is DVs, which after a lull for some time have started to see improvement. So these are 4 exposure in the healthcare side that we have. Ajay, you are on mute.
My apologies. Thank you again for the answer. The question really now is coming more again on performance. So the question is that we are holding a few stocks which haven't been performing for a reasonably long period of time, maybe a couple of years. You spoke about Chamam Finance for that matter. And the follow-up on that specifically comes in from the same individual, is that what is the reason for having a very high weightage to stock like a Cholamandalam investment?
So first of all, weight has increased. We have trimmed our holding. But nonetheless, if I look at what Cholamandalam Finance has done, I think they have actually been a role model in a way, so as to say. The way they have moved beyond, I mean, if you think about Cholamandalam of the past, it was largely a CV player, right? Today, they have diversified it really well. CV is not a large part of their business anymore. Possibly new CVs are like less than 15% of their business. Over period, they have diversified into passenger vehicle. They have diversified into tractors. So that's one piece. Their home loan business is also kind of doing well. And add to that, they have incubated three more businesses some time back, which is adding on to their growth rate. What is the outcome? Their credit growth has been way superior. Even when we are seeing slowdown on the CV cycle side at the current point in time, they've still grown their AUM upwards of 30%. For the year as a whole, can we anticipate 25% plus AUM growth? I think we should. And this kind of diversification with this kind of growth actually has been delivered with very controlled credit cost and improvement in ROE. See, for any lending institution, while growth is important, but this growth has to be in combination to NIMs, credit cost, and ROE. And we see this company scoring well on each of these metrics, which is why we have been slow in kind of pruning this name. In fact, we continue to anticipate pretty decent earnings compounding from this company. Sorry, can you repeat? Your voice is not clear.
Well, if you can just throw some light on a few other draggers that we had earlier and what action was taken, or we continue to hold those names and the rationales for that. For example, Asian Paints for that matter, or you have a few names like that in the portfolio.
So see, if you look at Asian Paints, our holding is very limited. We have trimmed our holding pretty meaningfully, and not now. For a while, the holding actually has come down to a very, very small level. I mean, it's about 1.3 to 1.5% of our portfolio. And, you know, this is an area where in the past, at least whenever competition has come by, we've seen Asian Paints actually defending their turf really well. So to that extent, we'll monitor it very closely before we kind of decide on to the balance. But we have actually, if one thinks about the draggers per se, many of the draggers wherein performance has not been up to mark, we have kind of shedded those from the portfolio. Those businesses where performance has been reasonable, or we anticipate a very sharply improved performance from them, we have been rather more than willing to kind of hold on to them, but monitoring it very closely. And if after a point, if markets don't kind of deliver onto them, we'll take call appropriately.
Thanks, man. Again, a lot of questions coming back on the performance side itself. Maybe if you can just revisit what you spoke of, because people are saying that it's underperformed the benchmark BSE 500 specifically. And how do we see this portfolio really bouncing back? So maybe your views for the next, I mean, you did give a broader overview in terms of how you see EPS growth and the return ratios for the next couple of years. But if you can just give a broader outlook again in terms of what has been the, again, reasons for draggers or the gap in the portfolio, and what is the assumption that we can see from the portfolio going forward?
Sure. So see, versus BSE 500, if one were to think about what has been the reason for the benchmark, what has been the reason for underperformance versus the benchmark. Clearly, absolute returns have not been a big challenge. It has been more about how has the relative performance been. First, we have always focused on superiority of business. That's vital. Because we don't want to be hostage to any eventuality that may come up. Certainly, when things go really bad, we'll also suffer. But in the past, we have always seen that when we kind of buy into high quality businesses, we tend to these businesses tend to kind of do a lot better than what it is for the benchmark, right? So to that extent, they are built to last, right? They're built to last long. Having said that, versus BSE 500, what has been the rationale for, what has been the reason for underperformance? Clearly, two important aspects. PSUs doing phenomenally well. PSUs with about 11-12% in the benchmark and delivering close to about 90% has been one of the reason. Another reason also has been small caps, under allocation towards small cap. Having said that, there was, why do I believe that possibly worst may be behind for us? We should actually start to do a lot better versus on a relative basis as well. Absolutely, I have no confidence that these businesses, given the fact that we anticipate a reasonable earnings compounding for a significantly longer period of time. The longevity of growth is something that's very important. And this profit growth actually will be backed by a very superior capital efficiency. And which is why cash flow growth will actually be superior. So this makes us believe that long period absolute return should be delivered. Why do we believe that on a relative basis as well, we should start to perform? The profit divergence versus benchmark should start to show up, right? Our profit growth versus the benchmark is superior. And valuation premium has reduced versus what it was in the past. So which is why just a top-down view. Obviously, we think about businesses from bottom up, why each business will perform. That should kind of deliver us the performance.
Great. Good to hear that, Smith. Again, a stock-specific question. You spoke about banking sector exposures really coming off for the portfolio. What is the rationale behind holding a stock like AU Small Finance, which has been, again, a bit of a dragger?
So, till some time back, we just had two banks, and now we have actually exited IndusInd Bank as well. So at the current juncture, we just have one bank in the portfolio. And that too with a very measured weight. And I really believe that, AU is at a point where cost to income actually should start to get better. They are at 60% plus cost to income, one of the highest actually. So, their AUM growth continues. But cost to income, while NIMs may continue to remain under pressure, but at the same time, in case of AU, I really believe that cost to income should actually give them huge leverage. Second is they have also invested into multiple incubating new lines of business within banks, which at the current point in time are loss-making. Those at some point should start to turn, which will actually lead to improvement in ROE. Right? Third aspect, which is not really relevant from a short-term perspective, but over period, we will see AU Small Finance Bank turning into a universal bank. So this is the only exposure in bank that we have at the current point in time.
The next is more forward-looking. So forward-looking in terms of what spaces in the portfolio do you really see providing the alpha that we normally talk about in the portfolio? Will it be your earlier traditional exposures or newer ones that you added to the portfolio?
So I mean, see, last few years, we've seen the entire consumption basket not doing well. I think we are seeing some signs of things turning around on the consumption side. So that part of the portfolio actually should do reasonably well. Also, our exposure towards infra engineering was rather limited. We have increased that exposure a bit. Right? So to that extent, I really believe that should also start to do well. So, and obviously, I talked about our focus areas, right? Which are consumption, investments, healthcare. We would look for names in circular economy ecosystem. Similarly, agriculture economy should also start to actually do better, right? So those are the areas where we would be relatively more focused on.
Sumit. Again, a few questions coming with regards to the anticipated volatility that is expected, markets being slightly more overheated. You had the yen carry trade issue. You had taxes actually going up. You had the elections, which you spoke of as a risk. How do you think the IP portfolio is really positioned to, if it's possible to really maneuver such events, or do you think that the impact on such events might be slightly lower on ASK portfolios versus the rest of the market?
So see, frankly speaking, it is very difficult to say at the current juncture what will induce volatility in the market, right? What is that factor which will make markets a lot more volatile? Having said that, how do you respond, right? You respond by buying into businesses where you think the character of business, the quality of that business, quality of that management, the opportunity size is not challenged. Right? Opportunity has to be secular. It can't be something has happened in the world and which is why the opportunity has changed. I mean, so to that extent, if you look at our investments into businesses, I would say each of the business that we own are very solid from this perspective, right? So it's like saying we are prepared for volatility, even if we see volatility in the market. And obviously, we'll have to respond accordingly if there is anything specific from a volatility perspective that hits. For example, if any unforeseen event, like think about it, we saw demonetization way back, right? And demonetization actually impacted our part of the market a lot more, right? But that also meant that over period, much of our businesses, which has this ability to increase market share across varied business environment, we saw them actually increasing market share at a relatively faster pace. So we'll have to respond to what is that event which actually kind of induces that volatility. But all what we have done at the current juncture is focused on businesses which I would think are at least last man standing in their own area of operation.
Interesting. Again, the next question comes in with the fact that, and you spoke about this, that seen a broad basing of the market quite a bit in the last few years. And has ASK been able to increase the number of stocks in the portfolio? So maybe if you can share the number of stocks that we used to have maybe a couple of years back, and how has that maybe changed in the last couple of years for IEP?
Not only for IEP have we increased number of stocks, but as a house as well, we are invested into a lot more businesses. But talking particularly about IEP, see, if you look at our portfolios of the past, we used to be invested into about 20 odd businesses, 22 businesses. Today, we are invested into 28 to 30 businesses. Right? So number of investments have actually gone up, and opportunity in the market has also increased.
So we are trying to capture those opportunities in the portfolio. Great. Just last couple of questions. And again, if there are any more questions, I'm more than happy to have them in the chat box. You spoke about the earnings for this quarter being 18% for IEP and 4% for Nifty, and maybe another 8-10% for BSE 500. Within the ASK portfolio, and so I'm excluding commodities, you spoke of commodities being draggers for the index, cement being draggers, OMCs being draggers. If you remove these names, what has helped us deliver of what businesses have really delivered better numbers for us within the IP portfolio this quarter?
So, it's not that it is one or two businesses. It is multiple of those businesses which have delivered very superior compounding, right? We always, if you look at our portfolios over last many years, um, we always believed in one thing, which is most of the returns or returns should be delivered by most of the stocks rather than one single stock kind of delivering most of the returns, right? Because you want so as to call as all rock stars, right? Rather than just one rock star. And to that extent, uh, the profit performance is by many businesses rather than very concentrated performance by few businesses.
A very interesting question, and probably the last one before we close the floor. On paper, the portfolio, it looks to be a great portfolio. I mean, you have some very strong names. Earnings, as you showcased, have been strong for the last few years. You anticipate earnings to be strong in the current year and, in FY26 as well. You spoke about valuations where everyone's talking about valuations being expensive in small caps, mid caps. You are talking about discounting on valuations here. So, it looks to be a great portfolio, but is it finally that time where we start seeing IP back to those glory days of 18, 19, 20, 21?
So, if you look at absolute returns, FY24, portfolio delivered absolute return of 32%. Even this FYTD portfolio on an absolute basis is up reasonably. Markets actually have done way better, right? Having said that, I really believe this is a time where, since I expect relatively less divergence across in profit, but in across ownership or across caps, relative divergence in market performances also should go down. And when there isn't one outlier which is kind of moving the market up pretty sharply, when markets are more normalized, I have little doubts in our ability to come back and deliver on a superior performance.
Thanks, Sumit. That's a great answer. So we have no more questions from the audience. Any closing comments from your side? And then we'll end the webinar.
No, that's it. In fact, I would say possibly, I mean, at least given how earnings are shaping up relative to market as well, while absolutely they have been shaping up well, but now relative to market as well, the confidence level is reasonably high that we should be at a point where the performance on a relative basis should start to look way different. That's my thought at the current point in time.
Great, Sumit. Again, thank you. Such a pleasure having you in the call today. And thank you so much to all the members who could join us today and listen to the webinar. We will keep doing these webinars every quarter. So we would request you if you can just keep participating the way you've been doing in the past. Thank you and have a great week ahead.
Thank you. Thanks a lot.